Welcome to this edition of Business Redefined. As always, this platform is dedicated to demystifying financial literacy in this country, and particularly the conversation on various asset classes. And today we are privileged to have Mr. Einstein Kihanda, the Chief Executive Officer at ICA Asset Management. Welcome on set. Let's talk about real estate investment trusts.
Thank you very much. Glad to be here this morning.
It's been about 6 years since the debut product went to the market, by way of REITs, I mean. What's your assessment 6 years down the line? How is the uptake? How is the market responding to this?
I'd say it's been an interesting journey. With the first listing in November 2015, starting with the initial listing, the uptake wasn't as expected, partly due to the complex nature of the asset class. And as the investors tried to understand what it meant, there has been a lot of, and also the underlying issues regarding property, the property markets, and also the property portfolios. So I would say it's been an interesting journey. I would say also the other major milestone has also been last year with COVID, having a very significant impact on the property market, and therefore also in terms of the REIT, which we indicated when we published our financial results for the year ended 2020. So it's been a very interesting journey. So whereas the success has not been as expected, when you look at the history, because one of the other things that we've learned, of course, is from the growth of REITs. REITs started back in 1960. We're talking about a 60-year history. It's when you look at the financial markets, it means within the continuum of history, REITs is fairly young. And therefore, I think the same can therefore be applied even in our own market, that we will grow. I see prospects being much stronger now than I would say it was 6 years ago. So there have been very important lessons learned, and I think that gives us the momentum to see what it is that we can do to ensure that there's continued growth in the market.
Real estate investment trusts, pool investments, for the ordinary Kenyans who don't even understand what these are, help us make sense of this.
So real estate investment trust, or REITs in short, is a structure that enables pools of funds or investors to own real estate. And breaking it down even simply, if you have a REIT that owns only one property, what that does is that a promoter brings investors together and assume that building is valued at 100 million Kenya shillings. So what this investor will do is to pool this investor and assume the number of investors that come into that pool are, say, 10. Now, this 100 million, at the point when you're bringing these investors together, the value of that property is 100 million. So you bring in those 10 investors, each of them will own, say, a unit, and you decide the number of units are 10. So each unit is valued at 10 million shillings. So each investor will own one unit in that particular REIT. What that means, therefore, is that this investor or this building is jointly owned by those unit holders. The thing that you address by having a REIT structure is, number one, is that you have diversified the pool of investment or investors that own that particular property. Number two, you also address issues of liquidity. We know very well that property investments are not easy to liquidate. One of the biggest challenges that any property owner faces is, if I decide for whatever reason that I want to dispose of my property, it will take you a very long time, sometimes years, to complete a transaction. Now, when you have a REIT, it means that you also have a pool of investors. And one of the other things that you may do, it could be listed like the Island Fahari IREIT, or it could be on the USB board like we have with Acorn. And what it does is that it provides a platform for the unit holder to exit if they wanted to. And other investors can also come in.
Kenyans have very peculiar investment habits. There is an inclination towards the brick and mortar. I want to actually see this house. I want to own it by myself. Possibly I want to even construct it by myself. Here you are coming with an alternative vehicle. How would you assess the level of market readiness for this kind of structures?
So I'll answer that two ways. First, let's talk about the psychology. You're absolutely right. As Kenyans, we have an obsession with property. We all want to own property in one form or another. It could be rental units. It could be an occupied land or unutilized land. And I think the first thing we need to address is the fact that it is okay to own real estate through another form of ownership. And this is where investor education comes in. Remember when I talked about jointly owning a building? So rather than having that piece of land 300 kilometers away, which you're not even sure about whether it's occupied by squatters or not, or you need to make investments to make it earn you income. What REIT does is offer you an opportunity to participate in a fairly transparent structure with regard to property ownership. So I think the first thing we need to address is, number one, how do we convince Kenyans that this is, you do not have to own property in this, just by actually having the brick and mortar, and so that you can see the title deed, for instance. And one way of looking at it is, in the same way you buy shares in various companies that are listed at the Nairobi Securities Exchange, is the same way you can actually invest in REITs. So it provides you with an opportunity to do so easily. There is liquidity. You can buy and sell and trade in those securities. The second thing that I think is very important is with regard to the property owners themselves, that it is possible for you to bring whatever pool of properties that you have under a REIT structure, which is also fairly transparent, and it also provides you with an opportunity to diversify your holding, to spread out your risks as a property investor. And so there are benefits that accrue to that for the investors, for the owners, the property owners who would bring those properties into a REIT, and for the investors. So there's also a lot of transparency in terms of investors being able to understand how is the underlying portfolio performing. You entrust, one of the key elements of the structure of a REIT, there are various service providers that are listed. I will not go into all the details of them, but they include a REIT manager, property valuer, an engineer. All these providers are to ensure that there is efficient and effective management of the REIT. There is full accountability of all that is going on in terms of the day-to-day management of the REIT. So a lot of detailed information is provided.
I like the cross-referencing you did with the shares in terms of the way you can invest. And the question here is this, Einstein. You're designing a product, or the products are now coming into the market, whereby the primary mode of income generation is the dividend payout we get through REITs. But this is a market which is extremely consumed by capital appreciation. Do you think there's a misalignment here in terms of what is being offered in the market expectation, or how does that work?
Okay, that's a good question. And the way I would look at it is, it's important to look at what asset class are you investing in. Remember, what REITs does is really provide a structure or a vehicle. The underlying asset class is property. And so the features of property are really what we should be, the attributes of property are really what we should be focusing on as I answer that question. So the question is, if you own a building, say you own a commercial building, as an owner and as an investor, what can you expect? You expect that you'll earn rental income. Exactly. So if you're in a REIT structure, what the REIT structure does is that it ensures that the regulations say that you should distribute 80% of the distributable income of the REITs. So the REIT owner or the unit holder is assured that from the distributable income that the REIT makes, they have a dividend payment that will come to them. Now you talk about capital gains, but as a property owner, you only discuss, the impact of capital gains would only arise if you sell the building. So the question that then I would ask is, how often are you selling buildings? How often do you sell buildings in this market? And it's clear, it's not every day. So I think the other thing that one needs to, therefore, the investor needs to expect is that the same attributes that you see in property investments are the same that you would expect in REITs. And therefore, if it's an income REIT, for instance, it is really about the stable income that is earned by the underlying portfolio. So that rental income will be coming to you at the end of the year, at the time when it's being distributed. If it's a development REIT, then over time, you can expect that there will be some capital gains that will be realized. So it really depends on where you would be investing in.
You've mentioned something very important, income REITs and development REITs. Distinguish them for us, please.
So an income REIT is a REIT that is focused on income generating assets. So it's rental income. So it means that it is a REIT that has invested in assets that are expected to earn income. That is rental income. So it could be a building, it could be a commercial building, it could be flats. That is what you call an income REIT. A development REIT is one that is, as the word says, is focused on property development. So you invest in the REIT, and the REIT, say, for instance, has land and is looking to put up these property developments with a view to ultimately selling them off. And in the process of the value addition that happens, as that property development grows and is put in place, you as an investor will then realize the benefits that arise from that property.
Skeptics of rates will tell you that the market, the real estate market, segments of it at least, have experienced subdued rental yield. What is the outlook like in terms of, if I invested in this, my return? How does the projected profile look like?
You're right, and I'll cite two factors. One is immediate, and the biggest one is, of course, the impact of COVID on the property market. Because one of the things that we saw with COVID, because of the overall impact it had on the economy, because of government regulations, some businesses had to close down. And what that meant is that they actually had zero income. Now, as a property owner or as a landlord for these businesses, what happens? You have to work out an arrangement because it is through no fault of their own that they are unable to function. And therefore, it meant that there's loss of income for that particular landlord or property owner. We've also had a significant increase in supply of space, commercial space, residential space. And I think that has also affected the performance of, in terms of rental income. And I think if you read the reports that we've seen on property performance, certainly there have been cases where we've seen actually land prices of value of real estate in certain locations decline. So I would say, in answering your question, number one, the underlying factors that are affecting the property industry would certainly affect also REITs. Now the difference is that what I think would be a distinguishing factor is the ability of the REIT manager to be able to understand those dynamics and therefore position the REIT to be able to take advantage of opportunities that are there, or have mitigating factors. So while I would say that the outlook remains challenging overall for property, I think there are certain sectors that still present opportunities, and I think it is really about the understanding, for instance, whichever REIT it is that you're looking to invest in, what is the strategy for the REIT? What sectors of the property market are they investing in, and what is the outlook? So I would not say that it is a gloomy outlook. What it just requires is for us as REIT managers to be more discerning and spend a lot more time understanding exactly where it is that we should position ourselves, as investment managers.
Looking at the regulations which anchor REITs in this market, of course, developed by the Capital Markets Authority through public participation as well, a required payout ratio of 80% looks extremely high in my view. How do you assess it?
That payout ratio is, remember, REITs are tax exempt. And one of the things that is really, was really important is in order to ensure that there is that tax exemption, you also have to ensure that the returns and the payout ratios are commensurate with the exemption status and the returns to the investors. Now remember, this payout ratio is only for the income REIT. And the reason for this is really that it is important, for instance, to ensure that that REIT is efficient, is managing the property portfolio in a way that is market-driven and ensures that all the resources that are necessary are put in place. And I think it is an incentive also to the investor. And as I said, this is attributable only to the income REIT. So the assumption is that you already have an investment. You already have a property investment. And if you manage it well, you should be able to provide that return to your investors.
Getting to what you just talked about in terms of tax exemptions, I haven't seen any other asset class which has such a sweet spot in terms of tax incentives like real estate investment trusts. Even if you followed the latest budget, the VAT which had been clawed back has been returned in terms of an incentive. But still, the market seems not to warm up to this. Are we missing the signal here, or what's the case? Because when you sit down with the policymakers, and the question they ask you is, then why are we extending all these incentives if Kenyans are not coming on board?
I think it's a question of a lot of investor education, in order to make it clear to the investors that these are the incentives that are available to the investors. It is right that the incentives are in place, but I would also look at it from a perspective that you need to be patient. We are gradually seeing more and more REITs coming into the market. We now have 3 of them, which was, for a long time, Fahari was the only one. But this year we now have 2. And from what I know, that there are more coming into the market. So I would say that the incentives are useful and helpful, because what it does is that it makes it easier for investors to put their property investments, or the promoters to put their investments in the REIT structure. And it also makes it attractive to the investors to be able to, the unit holders, to invest in REITs.
There is a view, rightly or wrongly, that real estate in this market is significantly distorted from a pricing and valuation standpoint. And I'll give you an example. You ask someone, how much is this property going for? They quote some tens of millions. You ask them, how much can I get in rent from this? They give you their figure. If you compute the rental yield, it's coming to about 3%, which simply tells you, this is an overvaluation of this property. Is that a problem for REITs? Do you see it as a challenge, or how do you view that?
Yeah, it's a good question. I think the issue of valuation in properties is a critical aspect, because at the end of the day, it determines the kind of returns that investors are able to get. What I would say is, and a lot of the development that we've seen lately in terms of pricing is really asking yourself, what are you basing that valuation on? Is it cash flows? What are really the fundamentals? And I don't want to go into all the details, but I think one of the more important ways of looking at or referencing is actual transactions, because those are some of the questions that we one would need to ask themselves. So for instance, if you're saying that my building is valued at, or a piece of land is valued at 100 million, what's the last transaction that took place on a similar piece of land within that vicinity? Yeah. And I think what that does is now bring in reality. And I think that is what you're also seeing in our market right now. That the factors that, the overlying factors, especially relating to the economy, COVID, etc., are now coming into play. And they are actually affecting the value of properties. And we are seeing that gradually, on the ground. And so that issue of the overvaluation may become less and less of a factor, in time.
The nature of real estate investment trusts is that more often than not, you'll be out there fundraising. Yes. And at an individual level, it gives me concerns, particularly in a market whereby, for a long time, I know it's improving now, there was a bit of a liquidity dry up, or investors just withheld their funds. How do you ensure your sustained liquidity pool, given the kind of demands that REITs create?
You cannot ignore the issue of fundraising, because at the end of the day, as a REIT, for you to achieve economies of scale, for you to be able to provide sustainable, competitive returns to your investors, you need to grow. You need to keep, growing. And that's where the issue of fundraising comes in. And what are the factors that affect your fundraising? Number one, of course, is your pool of how is your underlying property portfolio performing? And this is where also the REIT manager is also judged. So it is really about confidence in the ability of that company to grow. So it's exactly the same approach that one would look at from a REIT perspective, because the market is dynamic. There will be opportunities arising. You may be an income REIT, and there's a very attractive opportunities that has come your way, and you feel that it is important to be able to take up this opportunity. So one of the ways you'd look at is, how do I raise funds to ensure that I'm able to acquire this property and bring it on the REIT? So the issue of fundraising can never be out. Has always got to be an issue that is recurring at all times for any investment that is looking to grow.
Do you see institutional investors warming up to this? And why I'm asking this, if you look at the 1.4 trillion shillings worth of assets under management, the bulk are in fixed income securities, the rest are in quotable securities, a bit in corporate bond, which was disappearing but now coming back. Do you see them warming up to REITs?
I must say, for instance, number one, we already have institutional investors that are invested in the REITs. Actually, the REITs that are listed, that we have in this market. So I think it's a question of having more and more coming into the market, because again, I can tell you as a fund manager, now wearing the other hat of a fund manager, pension funds struggle in terms of property acquisitions. Unless you're a very large pension scheme, for you to be able to have access to property investments, you need significant capital. But if you want exposure and you're a small fund, you actually don't have an option. The option that is presented to you now would be in REITs. So I see that as an avenue through which smaller funds can be able to diversify their investments, because the diversification has been very important. With all the shocks that we've seen in the investment environment, it's important for pension funds to be able to diversify.
Right, and that point by Mr. Einstein Kihanda takes us to the close of our conversation on Business Redefined, where we have been demystifying real estate investment trusts. And we shall continue focusing on various other asset classes depending on the questions that we are getting, to be able to equip the knowledge, the citizens out there with the knowledge they require to take their investment decisions. So stay tuned.